folks, we're back, baby. Look at this. The flu's got not a single thing on me. I'll smack the crap out of the flu. You give me any disease, any infectious disease, I'm going to teach you who the boss is. Look, let's just be clear. We don't need to make vaccines for anything. I'll beat the crap out of anything. Just give it to me. Give it to me. Doctors should be studying this guy. Peak human health. The fever only went to 103 once, okay? And guess what? I said I'm done with that and my body shut it down, baby. You're done with me, flu. So, obviously, we're prepared, for a great day tomorrow. Got a couple great earnings to look at tomorrow, but today we're getting back in the swing of things, talking about earnings, because this is the first earnings video. P&G stock, one that, obviously, I know P&G well, so that's why I went ahead and I wanted to talk about this today, on top of the fact that this is pretty well unheard of for this stock. An actual movement on earnings. This stock doesn't do that. This is one of the classic rocks, steady rocks that doesn't move really for any news. All right, P&G does not move for any news, and obviously you can see it by a good really resilience here in 2020, where they only fell 18%, nearly 20% about is the most they fell in 2020, when every other, the entire market's fallen 40%. So this is a stock that doesn't move much. So to see a nice bump is pretty good. And there's a couple reasons for it, in my opinion. I still think we're going through the shift out of tech. That's just a thing we're currently going through. How long will it last? Look, no one can predict it. But you can kind of see that shift where, as of November here, this thing's up 12%. This is not a company that moves 12%. And again, you can see that because in the past 5 years, 85% up through a massive bull run. It typically does not move this way, though. It typically trades pretty steady. Not like it has really as of, the last 5 years. So, but this span has been crazy this last month and a half. So let's look at these earnings, though, see why we're seeing an increase here in share price. So this is also pretty nice here. A non-GAAP EPS line of $1.66. Definitely going to look at the GAAP line, but that beats by 1 penny. Nothing crazy there in terms of the profitability, so we're okay with that. The revenue line, though, this is pretty impressive for me, all things considered, because this company doesn't typically post numbers like this. $20.95 billion, up 6% year over year. That's a pretty large percentage growth for this company, so pretty impressive. And to see a beat of $610 million, it's not something that they typically do. So that's kind of why I'm pretty excited about that. What's good here too? Obviously, they mentioned organic sales. They're gonna have to. It's a main focus of investors. They think it's the main focus of investors in Wall Street. All of these companies are going to be talking about their organic sales. Isn't that relevant to me personally? I don't care all that much. 6% is not like the world's craziest thing. Obviously, organic is a trend, and they want to. Obviously, that's why they're reporting it so much, because it's trendy to do. But here's what's awesome too: a raised guidance for the full year. This company also doesn't typically do that either. So to see the trifecta of beat, the beat and raise, the trifecta is always nice for a stock. It's good to see it go up as a result too, because you never know with this market right now. Guidance has gone from 2 to 4% to 3 to 4% growth expected in all sales versus a consensus of 3.96. So it's not all that impressive. Organic sales now from 4 to 5% as opposed to the 2 to 4% before, so that one's a little bit larger, but again, not a very large percentage increase. Nothing to write home about. Core EPS growth to be in the range of 3 to 6% versus the consensus of 4.43. In my opinion, that's pretty online. Nothing crazy. Capital spending estimated to be 4 to 5% of net sales. Nothing crazy there either. But they have also increased the outlook of the free cash flow productivity to 95%, and now expects to pay over $8 billion in dividends and $9 billion in repurchases. Repurchase 9 to 10 billion, I should say, of common shares. Obviously, a lot in the repurchase program and a good dividend payer as well. You like to see really both for a company. It's two things that are impacting the stock positively. And in my opinion. You look at the press release. Look, this isn't anything special. I mean, there's nothing crazy to really report in terms of this. Do I care much about the organic sales? Not all that much. From a net sales perspective, obviously you see 19.7 the year prior, off of a year where they really showed a good increase. Against 2019 numbers, you've seen really great numbers as of late, so that's fantastic stuff. Is there anything crazy? Well, we look at the segments. What do we like to see? We see net sales increases in every single thing. The dog is having a good time back there, I presume. Beauty up 3%, grooming 4%, healthcare 8%, fabric and home care 7%, and baby and feminine care up 5%. So positive in all aspects there. Organic, I don't know. I mean, no, who cares really? Sorry, is that rude of me? It might be, but I don't care all that much. So the beauty segment, obviously they mentioned there, mostly due to, as they say, personal care growth, due to innovation, market growth, and pricing. Nothing crazy there. That means inflation is what pricing means, by the way. The grooming segment, they'll talk about the same exact thing. You're going to see pricing growth undoubtedly with these companies, and that's going to benefit them. It will hit the bottom line, right? Undoubtedly, the net earnings, I think, will be at a point of it'll be a point of emphasis. But we will see revenue increase with a lot of companies as we see. What do you want, dog? As you see inflation kind of reign over there. So diluted net EPS here, $1.66 as we saw, which is a 13% increase over the prior year, which is really nice, all things considered. We saw the guidance, nothing crazy. Let's look at the balance sheet. It's something we love to do. We love looking at balance sheets, okay? That's the thing we love in this house, and I can talk now, so I'm going to definitely talk about this. So, this is a 6-month comparison. Not my favorite. I like to look year over year in terms of a balance sheet, but that's okay. 6 months tells us a story. It tells us a story. Total current assets at $25.5 billion compared to $23 billion. We see a growth in the cash position. Curious if that's, I presume that's going to be allotted towards share repurchases. That's why they're building that up a little bit higher, in my opinion. Inventory is obviously up too. As I mentioned I mentioned previously, a lot of these companies are really starting to build up on inventory finally, where they weren't quite able to see it over the last couple of years. So we're able to see an increase in inventory there. Total assets in general grew by really just about that much as well. 121.4 compared to 119.3. There's growth there, mostly in the current segment though, so nothing crazy. What does the liabilities look like here? Total current liabilities at 38 compared to 33, increased quite a bit. Accounts payable went up, and obviously there's some debt that looks like it's matured, so that's really the majority where it came from here. Over the last couple months, it looks like this debt matured to the tune of really over right around $4.5 billion extra in terms of what they had before. So definitely something to look at. From a long-term standpoint, liabilities in general still increase as well. 76.5 compared to 72.6. I would have hoped that you would have seen a little bit of a decline here in the long-term debt, that some of this that matured would have, not necessarily been added back, but it did. It's okay. Shareholder equity is really good on this company, though, as you can tell. 44.8 billion compared to 46.6. It is headed in the wrong direction, but it's not something I necessarily hate with this company, with a proven track record of profit. And they're doing great things, so not necessarily any concern for me. I think it's a pretty decent balance sheet out of this company. Now, is it an exciting stock? No. P/E ratio right under 30. It's very high for historical levels. Very high. This is a company that typically trades around 20 when you're looking at fair market value historically. The yield's still over 2%, which is very nice, and a market cap of $392 billion. When you take that into consideration, the price to sales is pretty all right. So for full year, I believe they bring in $100 billion this year. This Q1, correct? This Q2, sorry. I believe they bring in, sorry, it's going to be closer to, all things considered, around $90 billion then. So the price to sales pretty expensive compared to historical value too. We're talking about 4 times that. It's pretty expensive. I can't lie to you. Look, it's not. It's hard to say there's ever a bad time to buy P&G stock because over the long term, I think you like P&G. Share appreciation isn't necessarily what you get in the stock for. You get in for consistency and a nice dividend. So it heard me talking crap about it, and it's coming back. So we're going to try to end this one real quick here. But look, it's not a screaming buy right now. It's a buy and hold for a long time. You'll be happy. I don't think the value is great right now, though. I'll just be 100% honest with you. That's what I got for you. Have a good one.